We live in a world where financial literacy is celebrated. Everyone wants to talk about compound interest, diversification, and market returns. But what if I told you that the real secret to financial success lies not in these technicalities, but in understanding ourselves? Welcome back to the channel. Today we're diving deep into the heart of personal finance. We're discussing the ideas from Morgan Housel's The Psychology of Money. And spoiler alert, it's not what you think. This book isn't about complicated financial strategies. It's a simple read that challenges us to look inward. It's about acknowledging that we are all flawed humans, not perfect calculators. And this shapes our relationship with money. If you stick around until the end, I'll reveal a key takeaway that will resonate with you if you've ever wondered why smart people make bad financial decisions. Ever felt confused by the seemingly random ups and downs of the stock market? Or maybe you've seen friends or family make choices that you knew would lead them down a rocky path financially. You're not alone. In The Psychology of Money, Morgan Housel takes us on an eye-opening journey. He highlights that our financial decisions aren't made by Spock, the logical Vulcan from Star Trek, but by us complex emotional beings prone to making mistakes. Housel emphasizes that we all have unique stories that shape our attitudes towards money. These stories are a blend of our upbringing, environment, experiences, and even luck. For example, someone who grew up during the Great Depression might view money differently compared to someone who has only known economic prosperity. These perspectives aren't right or wrong. They're simply shaped by different realities. It's like how each of us has a fingerprint. Our financial journeys are marked by unique events that define our relationship with money. These moments become touchstones, shaping how we perceive risks, rewards, and everything in between. Understanding these personal narratives is crucial. What may seem irrational to one person can be the most logical choice for another. There's no universal financial truth that applies to everyone. It's a highly personal game. You see, our financial choices aren't based on textbook scenarios. They're rooted in our life experiences, both big and small. When we look at our finances, we're not just analyzing numbers, we're examining the stories that those numbers tell. These stories are filled with characters, both real and imagined, that influence our decisions. As you continue this journey with me, take some time to reflect on your story. Think about how your past experiences have shaped your views on money. Maybe there was a moment when you realized the value of saving, or perhaps you've seen firsthand the impact of debt. Your story is valuable and it holds clues to your financial behavior. Now let's shift our focus to cognitive biases. Imagine you're standing at a roulette table in a casino. The losing streak has been relentless, yet you're due for a win, right? Wrong. Your brain is playing tricks on you, specifically confirmation bias. You're selectively focusing on information that confirms your belief that you're about to win, ignoring the cold, hard facts. This tendency to favor information that supports our existing beliefs is just one of many cognitive biases that influence our financial decisions. In The Psychology of Money, Morgan Housel points out that our minds have a remarkable ability to deceive us. We're prone to overconfidence, loss aversion, hindsight bias, and the list goes on. These biases act as hidden forces, nudging us toward choices that might seem right, but often lead us astray. Think about loss aversion. If you were offered a choice between a guaranteed $100 gain or a 50% chance of winning $200, which would you pick? Most people opt for the sure thing $100. This tendency to strongly prefer avoiding losses over acquiring equivalent gains is deeply ingrained in us. However, in the grand scheme of financial success, it might be beneficial to take calculated risks. But our innate loss aversion often holds us back. Then there's hindsight bias, the Monday morning quarterbacking of our brains. After the fact, everything seems clear. After seeing the outcome, we convince ourselves we knew it all along. This bias can trick us into thinking we're better investors than we actually are. We might pat ourselves on the back for predicting a stock's rise, conveniently forgetting that we also had our fair share of misses. These biases, while deeply human, can be detrimental to our financial well-being. Recognizing them is the first step to overcoming them. Understanding how our minds work against us is like exposing the enemy. Once we see the enemy clearly, we can start to develop strategies to protect ourselves. It's about arming ourselves with knowledge, not allowing our emotions or biases to dictate our financial moves. Now, Let's talk about the power of feeling like you're genuinely invested. Imagine you're holding a stock in your portfolio that you bought at a certain price. Now picture this, the stock starts to decline. You check it daily, hoping for a rebound, but instead it keeps dropping. One day you decide to sell, locking in your loss. A few weeks after you sold, the stock begins to recover. This is a classic example of the emotional roller coaster that is investing. Housel argues that the investors who feel most invested, not just on paper but emotionally, are the ones who fare the best. They're more likely to ride out market downturns, stick to long-term strategies, and avoid panic-driven decisions. On the other hand, those who view investing as a mere number-crunching exercise are more susceptible to knee-jerk reactions. They might jump in and out of investments based on short-term market fluctuations or chase the hardest trends. While the latter approach might seem appealing, it's often less profitable in the long run. Have you ever found yourself in a situation where you held onto a stock for too long after its price had already dropped significantly? Or perhaps you've quickly sold off a stock because it momentarily dipped in value. These actions are driven by our emotions, confirming that we're not just logical calculators, but real people with hearts that skip a beat when it comes to our investments. But how do we harness this emotional connection in a way that benefits us? It's about finding the sweet spot between being too detached and losing all sense of personal connection and being overly involved to the point where our decisions are dictated by fleeting emotions. It's about creating a space where we can acknowledge our feelings, understand their influence, and still make rational decisions. As you reflect on this, consider how emotionally involved you are in your financial decisions. Do you find yourself reacting impulsively, or do you stay calm and collected? Both extremes can have consequences. Finding the middle ground is key. How many times have you heard the phrase, money makes the world go round? This couldn't be further from the truth. Throughout history, there have been countless examples of individuals who have prioritized things like love, family, friendship, justice, and knowledge over money. From Martin Luther King Jr. to Nelson Mandela, these individuals demonstrate that money is just one piece of the vast and intricate puzzle of human existence. To reduce money to the sole motivator of human behavior is to ignore the rich tapestry of values, beliefs, and aspirations that drive us. However, it's important to recognize that while money might not be the ultimate driving force, it does play a significant role. It can open doors to opportunities, provide security, and offer a sense of freedom. The key is to keep it in perspective. Let it complement, not control your life. As we wrap up our discussion today, remember that the world of finance isn't just about balancing equations or maximizing returns. It's about understanding ourselves, our emotions, our biases, and our stories. It's about recognizing that we're all human, capable of making both wise and unwise choices. But it's also about knowing that we have the power to learn, adapt, and grow. Our financial journey is like a mirror reflecting our inner selves. By understanding and accepting what we see, we can navigate our financial lives more wisely. And if this exploration resonates with you, if you've gained insight into your own financial narrative or biases, please give this video a thumbs up, subscribe to the channel, and share it with someone who might also find it valuable. Thank you for joining me on this enlightening journey. Until next time, remember to invest in yourself first.